I'm Ryan Lightfoot-Brown of Chelsea Financial Services. We're joined today by Matthew Page and Ian Mortimer, managers of the Guinness Global Equity Income Fund. Thanks for joining us, gents. Interestingly, you both studied physics at university. Do you think there's a natural link between physics and investment management?
Well, I think there's not maybe a direct link, but understanding quantum mechanics and special relativity doesn't help you value a company necessarily. But I think what you're trying to do in investment management is take complex problems and try and adapt and manipulate a bit of maths in there as well to try and ultimately come out with an answer. But I think one investor said to us they like us being physicists because we understand what goes up must come down.
And do you think your background has influenced your investment process at all?
I think to some extent, yes. I think when you look at how we run the fund, we're very much sort of numbers driven. We're looking at fundamentals, trying to look at companies from the bottom up, if you like. I think we're very much sort of big believers in sort of hanging your hat on the numbers as opposed to sort of building your thesis around stories or sentiment necessarily.
And rather unusually, in your portfolio, you equally weight all your stocks. Can you just explain to us as to why you do that?
Well, we want to spend most of our time looking at which companies we want to own, not how much of them we want to own. And I think by equally weighting the positions, you're also limiting any stock-specific risk. So we're not going to have 9% of our fund in any particular name, and sometimes things go wrong, you have market shocks, and so it's an important risk control as well.
And what's your outlook for 2019? Are there any sectors, any geographies that you're looking at specifically where opportunities are coming up?
I think that's not necessarily how we look at the world in terms of trying to sort of predict the macro factors and how it will play out. I think in terms of how we're sort of building the portfolio at the moment and seeing where the opportunities are, we still see a lot of good quality companies, companies which have high returns on capital, companies that can reinvest and sort of build out their asset base. And we feel that over long periods, these are the types of companies, if you can buy them at reasonable valuations, will really much more drive your sort of long-term performance than it would in trying to figure out how many rate rises the Fed will have or whether sort of trade tensions will shift or change with the US and China, for example.
Lots of our investors will have UK equity income funds, but what are sort of the benefits of having a more global approach?
Well, there are some great companies in the UK, but the UK index tends to have a bias towards energy and commodities and financials. And so our kind of point of view is, why would you limit yourself just to UK companies when you've got companies like Procter & Gamble and Johnson & Johnson in the US and lots of companies throughout Europe and Asia as well. Maybe Asia's going to give you a bit more growth and dividend growth over time as well.
And what would be some of the risks associated with investing in a global equity income fund?
I guess one of the key risks we would see is investing in sort of income funds in general or dividend-paying equities is that you would focus more on the size of the dividend yield. So I think classically people would look at the sector and maybe try and sort of essentially boost the income they're receiving. One of the risks we see of that, and we've seen in markets more recently, is that if you chase yield, it does you very well as markets are rising. But what you might end up with is, near the peak of markets, actually owning quite a lot of companies that are actually a bit more distressed than you might first thought. What you then see subsequently is actually quite big drawdowns in some of those names. So the approach of sort of thinking about dividend investing as being slightly more defensive can actually be more problematic if you're chasing yield. And so what we try and do is really focus on moderate dividends and growing dividends over time. And therefore that avoids that risk of chasing yield as markets rise and maybe owning more distressed companies just at the wrong time.
Well, that's really interesting. Thank you very much for seeing us. For more information on the Guinness Global Equity Income Fund, please visit chelseafs.co.uk.